Hello folks, this is ICT with a quick tutorial on trading inside the range. This is a concept that primarily will serve you in all market environments. Most educators and most books will tell you the market stays in a trending environment or consolidation or trading range majority of the time, and that's partially true and it's partially not true. It depends on what you're looking for, but if you understand institutional order flow on the higher time frames, this will give you a greater insight on what it is specifically you should be identifying as the range and where the market should be reaching for. Okay, on the left hand side, we're looking at a buying scenario, or an area at which the market should be predisposed to go higher. You can see here the market is trading at a support level, and obviously this is a hypothetical example, but we're going to go into charts and show you what it looks like in actual price action. The market will have recently came away from an old high, and we're going to assume for this example that we anticipate the market to be moving higher on a higher time frame, something above this high up here, above this resistance level, above the bearish order block, above this old high. There should be liquidity up there, and if we see a return to an order block down here, okay, or it trades down on this price swing here into a larger order block that would be bullish, we would anticipate a move higher in price. Now here's the important thing: we don't necessarily need price to break out above this old high to be profitable. If we understand that the range in which we're trying to buy at an old order block low here, or this support level being noted as a potential larger order block that would be bullish, in those two instances, if we see the range between the smaller order block and the larger order block that would be represented by this support line, if they allow enough range to get back up into the bottom of this low here, or this swing high in here, whatever that up candle would be here, that's all you would need for potential profit. And if you look at higher time frame charts, there's a lot of opportunities where that manifests itself on a weekly basis. For a longer term swing trade, you can use this entry idea to move towards higher time frame objectives. We're seeking liquidity above this old high here, so you would anticipate a breakout above this high. But actually, once you're long here, you'd be taking logical areas of profit taking along the way. But the main thing is you don't necessarily need the range to break between the high and the low to be profitable. Okay, so that's why we talk about the idea of trading inside the range. There's a lot of trades that go probably past your radar if you're not thinking in terms of the market like this. And obviously, everything that I'm saying here could be said on the opposite spectrum. We're going to assume that the market has been moving up, okay, and on a higher time frame basis, that could be a 4-hour, daily, or weekly basis. The market trades into a bearish order block, or will be deemed as a resistance level, and maybe moved into a lower bearish order block in here. We would anticipate the market to rotate and trade lower. Now, again, much in the same vein that we are expecting price to move up here, we're going to be looking for price to be moving lower here. Now, we don't need it to break the low to form the current trading range. We just need to trade back down into this old high or this old low, okay, or trade right through this. Okay, trading through it to seek the liquidity below this low would be a swing trade mentality, okay, and I'll offer you a lot more pips in terms of magnitude for the short. But if you're looking for ideas to trade short like this, if you look at the range from the old high here, from where you're trying to short at up here, that range many times, if you're looking at a 4-hour chart or a daily chart, will give you a great deal of pips, and that's the setups you want to be looking for. They're bread and butter setups, especially if you're a one-shot, one-kill type trader like I am. I look for one good setup per week. These ideas will serve you well, and once it gets down to these old highs and maybe down to this old low in here, potentially trading into another bullish order block, we don't know if it's going to stop there, okay, or if it's going to break through and go through the old low. The reason why we don't necessarily need to know that is because we're trading inside the range that's been extended here, but also inside of the range that's been identified by the low and the high. So all we're looking for is setups on a higher time frame basis that allows us range from where we anticipate seeing a short form and where an ideal cover would be on that short. And if that range allows us a great deal of pips relative to the risk that would be assumed, then that's all we necessarily need. And if you take profits off here, you can leave a little bit on to look for the liquidity below the marketplace for a longer term swing. So let's go over to the charts and actually take a look at examples of that and really what it is that takes place inside the range. Date on this production is July 30th, 2016, and this week called fiber modestly higher, and we would be running out potentially the stops above this high. So we had a known range, and we'll draw that in here, and we had a known low. So we had the range high and the range low here. While price was trading up, we don't necessarily need this range to give up this high to be profitable, but nonetheless, this is Thursday's trading, this is Friday's trading. And if we go down to a lower time frame, okay, and we can see here's Friday's trading, here's Thursday's trading, Wednesday, Tuesday, Monday. If we know that this is the range high up here noted relative to the daily chart, we know that there's potentially liquidity up there. We don't need it to get there, but we trade with that idea that that's probably where it's going to be reaching for. We also have an old high here on Thursday, which we know that stops will be resting above that as well. So there's a lot of reason to anticipate price to be drawn up to these levels because of the likelihood of liquidity on the fund level, which is one of the primary drivers for interbank price action. Okay, so we have liquidity above these highs and the daily high noted with this level here. Okay. Now what I want you to look for is we see price rally from a range low right in here. Now why am I choosing this one here? Because it's a swing low right before this move up. So we're going to use that low in this high. So there's a smaller range inside of the larger range that we've just noted. So here's that low down here and the high relative to the daily range. Then we have this short-term high here, and we have a smaller short-term low here. So we have a range inside of a larger range with the ideal potential upside objectives still to be seen above this high and above this high. So what we look for is markets that want to run hard initially, which is what we're seeing here. Once we see that, we have a new smaller range. Now what we're going to look for is a retracement back into that, not just to any old specific level. We're going to look for one specific level, and it's going to be this. I'm actually going to draw it right on top of this candle, okay? And what we're going to do is show you the open on that candle is 10.72, 110.72. Okay, at the price we're going to drop our level on 110.72. Okay, price recedes away from that high, all inside this range right here. Price stays in this consolidation, but we're looking for primarily bullish conditions. Why? Because we think that this move up here was a little bit too quick, and price is most likely going to come back and return to the order block that started the up move. Okay, so this is kind of like a gap theory in price action. The reason why we don't see the gap so much on Forex because it's 24/7. There is no opens and closes except for the Friday's close and Sunday's opening. So when we see quick moves like that, we'll assume that there are gaps in there, and that's what causes the order block to be so sensitive. Again, the opening or high on this candle comes in at 110.72. The low on this candle here comes in at 110.72. Price stays in a small consolidation, then comes back one more time and hits that same specific level that we just noted. 110.72 is the low, and then ultimately price moves up, rolls through this high here, okay, clears out the liquidity, but look at the injection of volatility. Shoots through and then runs right above the daily high that we noted. right here. Okay, so both areas of liquidity are drawn out. Now, what's important is we see this idea as a buying opportunity here and a buying opportunity here. We don't necessarily need the range to give up this high to be profitable. It could just trade right to that high and fail, or fall just short of it and be profitable. The range between those two price points, if we get just to this old high, is 53 pips. If we get to the old high back on the daily chart, it's 116 pips. If we anticipate a run through it for the liquidity, it could be as high as 130 in terms of liquidity, almost 130, just fell short of 130 in terms of potential pips for that move. What is actually being seen in here, okay, is what we'll show on the bar charts website, and I'll show you what it looks like relative to a commodity, because I want you to understand why this range in here should close in, but it doesn't look like it is gapped or shown any kind of a pocket of illiquid trading. So let's go over to bar chart and I'll show you what exactly is going on. You can see it take place in a commodity. Okay, folks, we're looking at a daily chart of cocoa, and that's a foodstuff type of a commodity. All right, we see a old high up here. Price trades down away from it, comes back up, comes right back into this up candle. Okay, so it closes in that range. It doesn't go through the high. It doesn't just go just short of it. It just goes right to the very low of the last up candle or last up day of that commodity. This is exactly how the markets trade. So when we understand how markets book like this, you will see that it's a recurring phenomenon that the market makers use to facilitate trade. Now, here is, in essence, what a liquidity void is. Okay, this is essentially one of them as well. Okay, but not as illiquid. This is exactly what we're trying to illustrate here. Price comes all the way back up, trades up into the high of 31.66, just 3 points higher than what's necessary on this day's low to close in this gap. That's essentially what a liquidity void is. Now, we don't see this type of gap in Forex because it's such a fast market. It's 24/7, and there is no opens and closes associated with it, except for the Friday's close and the Sunday's opening.